Hello everyone, welcome to today's session. So today we are going to discuss our one next chapter, that is chapter number 13, which is group audits. Now, what this chapter is about and what we are going to understand in this particular chapter. Before we deep dive into that, any doubts from the previous chapter, any question from the previous chapter or whatever we have discussed till now, any doubts, any question? Okay. If no doubts and the question, then we can proceed with the chapter number 13. And meanwhile, if you have any doubts or question, then we can discuss on that. Okay. So what is group audit? What is, when I say group audit, can anyone tell me what do you understand by that? What is a group audit? Anyone? What is a group audit? No? So when I say group audit, what does it mean? Anyone? Okay. So when I say group audit, basically when you are going to audit in future, when you will become yes, Samanathan. You can unmute yourself. No?
Yes, sir. Good evening, sir.
Yeah.
Group audit means the audited the consolidated financial statement audit. So,
Yes. Yeah.
say when the entity having subsidiaries, joint venture, associate, or any one of them,
Hmm.
at that time where the audit will be done, that audit is called group audit, sir.
Yes. Absolutely correct. Very good. So when I talk about group audit, we are talking about multiple entities being involved into that. Remember, we have dealt with one particular standard using the work of another auditor, and we understood a concept called principal auditor. Yes or no?
Yes, sir.
So
600.
yes,
Sorry.
very good. Yes, 600. Absolutely correct. So we understood a standard called SA 600, where we understood the concept of using the work of another auditor. Now, when I talk about group audits, we are primarily applying the same concept. Okay, and we are also understanding the audit from a much larger perspective. So when I talk about group audit, it is nothing but it is the audit that we are doing of a parent entity and of the subsidiaries, and we are preparing a consolidated financial statement. Okay, so based on the audit, we are now preparing the consolidated financial statement. So when I say group audit is the, you can say, audit of consolidated financial statement, which is of the parent plus subsidiary. Clear? Okay, so that is the main thing that we need to first understand. Audit of CFS, that we will cover in the group audit. Now we have understood SA 600. We have understood the responsibility of the auditor as a principal auditor. Like when we are talking about principal auditor, what is his responsibility? We have discussed that in past. But now we will consider or we will discuss some special aspects of group audit, some special elements of group audit. Okay, so with respect to the group audit, we are going to discuss the special elements. Okay. So the first thing is which, let's talk about the company's point of view. Okay, it's a let's assume there is a company, or I would say ABC Limited. ABC Limited. Now, as per the Companies Act, which provision says to a company that you are required to prepare consolidated financial statement? Which provision requires a company to prepare a consolidated financial statement?
Ind AS 110.
No. So I'm talking about ABC Limited. Which provision of Companies Act? Requires preparation of CFS. Simple. Okay, which provision of the Companies Act requires preparation of books of accounts? Who says it is mandatory to prepare
Section 128.
128? Yes. And financial statements?
Schedule 3.
129(4).
129. Very good. Section 129 says to prepare financial statements. Now, when we see financial statements and when we see a specific subsection of that, that is section 129(3). Okay, 129(3). Over there, it requires that if a company has one or more subsidiaries, okay, in addition to the financial statement of its own, it shall prepare a consolidated financial statement of the company and all the subsidiaries in the manner, okay, as they will prepare for its own, okay, and it should be laid into the annual general meeting for the approval and review. Now again, there is a schedule 3, silent features, all those things are there, okay, and that is required to be prepared as per the manner prescribed. The financial statements are required to be prepared as per the manner prescribed, okay, and the manner which is prescribed is given in your rule 6 of company's accounts rule. So 129(3) says that where you are required to prepare financial statements when you have one or more subsidiaries. 129(3), that if you have one or more subsidiaries, then prepare the financial statement. Now, rule 6 says that you prepare the financial statement. Fine. But there are scenarios where you are not required to prepare the financial statements. Can anyone tell me about those scenarios where even I have the subsidiary, even ABC Limited, let's say ABC Limited has a subsidiary called XYZ Limited. Okay, this is subsidiary. Now, even ABC Limited has a subsidiary, still ABC Limited will not be required to prepare the financial statement, consolidated financial statement. There are scenarios. Can anyone tell me which is that scenario?
Yes, sir. There are two situations when that company is a investment company. Up to 2 level, it's not required. And one more situation is also there when the intermediate that holding company, say example, the XYZ Limited in this case is a intermediate. It has a subsidiary, and the above ABC Limited is a listed company and it's preparing the consolidated CFS, and the XYZ that all the shareholders and the NCA, if they are not have provided no obsession certificate, no obsession in each and every person with 100%, they are confirming that the okay CFS is not needed. In that situation, the XYZ Limited is not needed to prepare CFS.
Yes. Yes. Very good. So basically, there are two things or two type of exemptions which we can say where CFS is not required to be prepared. Now, why we are learning this? Why we are understanding where CFS is not required to be prepared? Because as an auditor, if the company, before, let's say for example, there is a ABC, you are the auditor of ABC Limited. Now ABC Limited says that no, I will not prepare CFS, I am not required to prepare CFS. But in that particular scenario, you should be aware, or you should know when the CFS is required to be prepared, or whether the provisions of the Companies Act are complied with or not. Then only you will be able to audit. So we need to understand when CFS is required to be prepared and where it is not required to be prepared, when there is an exemption. So basically, understanding all the requirements of CFS under Companies Act. We are understanding this. So that if tomorrow management says we are not required to prepare CFS, you should be able to understand that whether they are or they are not. Now, okay. Now let's talk about Rule 6. Rule 6 says that the consolidation shall be made in accordance with Schedule 3. Okay. The consolidation of the financial statement shall be made in accordance with the Schedule 3 and applicable accounting standards. So consolidation as per Schedule 3 and standards. Consolidation as per Schedule 3 and standards. Okay. Now, when I talk about accounting standards, okay, let's assume Ind AS is applicable. Let's assume Ind AS is applicable. Which Ind AS would you refer for the consolidation? Which Ind AS will you refer?
110.
Very good. Yes, Ind AS 110. So, in this particular case, Ind AS 110 would be the correct one, okay, for the consolidation. Okay. Now, Rule 6 basically says that if a particular company, okay, if a particular company satisfies 3 criteria, then they are not required to prepare the consolidated financial statement, provided they satisfy 3 criteria. So there is an exemption given in Rule 6, okay, which talks about this kind of, there is a provision in Rule 6. So the provision, or you can say exemption, says that you satisfy 3 criteria, then do not prepare the financial statements. Okay, the conditions are, number 1, that it is a wholly owned subsidiary or a partial owned subsidiary of another company, okay, and all its members do not object, okay, company not presenting consolidated financial statement. That means it is wholly owned subsidiary. This is the first condition. Wholly owned or partial owned. Subsidiary. Okay. Sorry. Now, plus along with that, all the members do not object. All members entitled to vote do not object. In preparation of CFS. That is your condition number 1. Second condition, securities are not listed. Securities are not listed. I'm not talking about public company, I'm talking about listing. In India, outside India, in the process, everything is covered. So securities are not listed in or outside India. Okay, the third condition is that the ultimate or intermediate holding company, because as I said, it is the subsidiary. So there is some ultimate or another holding company in the picture. So that ultimate or intermediate holding company holding company, okay, files CFS as required by accounting standards. Files, like when I say files, means they prepare and they present, they get it approved and everything. Then only you can file. So file CFS which are prepared as per accounting standard. When I say accounting standard, it will include Ind AS. Okay. These are the three conditions that are required to be fulfilled in order to claim the exemption which is given in the proviso, in the second proviso of Rule 6. This is of Rule 6. Very important. Second proviso of Rule 6 says that if there is all the three conditions are met, go ahead and do not prepare CFS. Clear? Any doubt? Okay. Now, there is one more thing that we need to understand. Okay, there is one doubt. What is condition 1? Condition 1, basically this part is where, let's say for example, in our example, ABC Limited was there and XYZ Limited was there. Okay. Now let's say for example, if ABC Limited is the company which we are talking about consolidation, and it is the subsidiary wholly or partly owned of this ultimate or intermediary holding company. Okay, if it is a subsidiary of this ultimate intermediary company, and all the members of this ABC Limited, they do not object in not preparing the CFS. Okay, they do not object that if the ABC Limited tomorrow decides, okay, we are not preparing the CFS, they do not object to that. Okay, not preparing the CFS. In not preparing of CFS. If that is a scenario, that's the condition 1. Okay. Second thing that I want to discuss is there is one more point in this particular rule. This is the first exemption. There is one more exemption given in Rule 6. When the CFS is not required to be prepared. That is the first proviso of Rule 6. It does not specifically say it's an exemption, but it talks about that. What it says, that if a company which is not required to prepare CFS under the accounting standards, they can only comply with, if they comply with the silent features which are given in Schedule 3, the summary which is given in the Schedule 3, that will be fine. So that section talks, that particular provision talks about a scenario where accounting standard provides an exemption. Now, in our case, we discussed that the relevant Ind AS, we are as of now discussing Ind AS. Relevant Ind AS is Ind AS 110. Yes or no? So, when I talk about Ind AS 110, can anyone tell me which are the companies which are exempted by Ind AS 110 from preparing the CFS? Anyone?
Investment company, sir. When it is having the subsidiary, and that
Okay.
also in investment company, only it's providing the service to the parent company.
Okay. Investment company. Yes. Good.
And also the same discussion we had discussed earlier, the three criteria, that also is applicable for India's.
Yes. Very good. So NDS gives two type of exemptions or two classes of companies who are not required to prepare CFS. So the class 1 is where they follow the conditions. Follow conditions, and then you are exempted from preparing a CFS. Which are the conditions? Similar. So condition number 1, you are a wholly owned subsidiary, partially owned subsidiary, okay, and all the owners. Here the term which is used in owners instead of members, because earlier we were talking about Companies Act, now we are talking about Indias. All the owners who are entitled to vote or otherwise, like all the owners basically, they do not object parent not presenting CFS. So you can say same as above first condition. Okay, only the wordings are a bit changed, but you can say the crux is same, that it is the same like this one. Partially owned, wholly owned of another entity, all its owners, they do not object the parent not preparing the CFS. That's the condition 1. Second condition. When I said earlier, I was talking about securities. India specifies debt or equity instruments. Debt or equity instruments are not traded in public market, a domestic or foreign stock exchange, or over the counter market, including local or regional markets. So it changes the wording, but somewhat similar to. Okay, and specifies debt and equity. Earlier I was talking about securities. You can say security is much wider term. Okay, securities are not listed or in the process of listing. Here the term which is used is debt and equity instrument. So kind of a same. Okay, so second condition is not being traded. So debt equity not being traded. Third condition, not in the state, not in the process of filing its financial statement with the Securities Commission or other regulatory organization for the purpose of issuing any class of instruments in the public market. That means it is not in the process of issuing any instrument in the public. Okay, means not any process of listing. They are not going for listing of shares or anything like that. So not in process of issuing instruments in public. Now these two conditions, basically, if I talk about, okay, these two conditions were similar to this one. These two conditions were similar to this one. So in Companies Act or in Rule 6 second proviso, we were only having this second condition. Now this second condition in accounting standards is bifurcated into second and third, but it is same as Rule 6 second condition. Okay. Fourth condition, similar, ultimate intermediary holding, parent, that is preparing financial statements which are available for public, compliance with the IND-AS, in which subsidiaries are consolidated or are measured at the fair value through profit and loss account in accordance with the IND-AS. Similar, that means ultimate or intermediate, parent prepares CFS as per Ind AS. Simple. That's the condition. That's a class 1 exemption, which you can say that follow these conditions and you get the exemption under para 4A of the Ind AS 110. Clear? Any doubt? Any doubt? No? No doubt? Okay. If no doubt, let's then proceed further. Now, this was a class 1 exemption. Now, there is a second type of exemption which is also given in your Rule 6. Okay. There is a second type of exemption is also given, sorry, in Ind AS, not Rule 6, Ind AS. That is para 4B. You can say class 2 or para 4B exemption. Which is applicable to a parent that's an investment entity. Investment entity is not required to present consolidated financial statements. Okay. And it is required to measure all its subsidiaries at fair value through profit and loss account. Now, there are specific requirement under Ind AS 110 with respect to investment entities, like how and how investment entities are required to prepare the financial statements and everything. Okay. Now, investment entity basically is not required to prepare consolidated financial statement, which is given in para 4B. So, investment entity is not required to present CFS. And I'm talking about parent investment entity. Clear? Any doubt with this? This is pretty much simple, straightforward. Any doubt? Okay. Now, these were the exemptions basically which are given under the Rule 6 and in the accounting standard. Now, the question comes is that if the management complies with these particular exemption, Rule 6 or accounting standard, then are they actually free from preparing the consolidated financial statements altogether? Or is there something else they are required to comply with?
With respect to investment company, they need to present in the fair value.
Yes, they are required to present at the fair value. But even if I get an exemption under Rule 6 or even if I get an exemption under Ind AS, there is something I'm required to comply with respect to the Schedule 3. So there is a specific section in the Schedule 3, take a Division 1, take a Division 2, okay, which talks about that you are required to present a separate section on the consolidated financial statement even when you are exempted under Rule 6 or you are exempted under any other, provisions of Ind AS. Even then also, they are required to prepare. So let's take an example. Let's understand with the help of an example and then we will discuss further. This is the publicly available data, publicly available financial statement. So for the purpose of your understanding, I have taken this so that we can understand what are the requirements with respect to the consolidated financial statements. Okay. Yeah. See this. Statement pursuant to the first provision of subsection 3 of section 129 of the Companies Act read with the rule 5 of the company's account rules in the prescribed form AOC 1 relating to the subsidiary companies. What is this basically is a statement which is required to be given by all the companies who are preparing the consolidated financial statements, or whether they are even exempt also, and they have to provide some information about the companies of their subsidiaries. So here they are required to disclose the net asset, shares in profit. A lot of things are required to be disclosed with respect to the companies. Now, if you see, these are all the subsidiaries they have specified. I will zoom in a bit. Sorry. Just a minute. Let me go back. See over here. Subsidiary, date on which subsidiary was acquired, country, reporting, exchange, all those things. Percentage of holding. So a lot of things are there in this particular format. Okay. This is part B, again, pursuant to the section 129(3) of the Companies Act related to the associate companies and joint venture. This is given. So there is additional information which is also given along with the consolidated financial statement, which is required as per section 129. So section 129 says that you have to provide these additional information. Okay. These additional information or silent features even when you are exempted by the rule 6, and that is to be provided in, like, this is AOC 1, the format which is there, this is AOC 1, so it is required to be provided in the format of AOC 1. Plus I'll show you something more. Additional reporting requirements under schedule 3. So there is an additional reporting requirements under schedule 3 where, as per the schedule 3, a company who is preparing, or whether or not, they are required to provide additional information on the subsidiaries. I'll just take you to that particular section. Over there, they are required to provide details about the subsidiaries as per the schedule 3. That's the part of schedule 3, even when they are exempted from preparing consolidated financial statements. Now, each and every company gives in a bit of different way. As you know, they some might combine at the level of, you can say, this particular note AOC 1. Some provides at different places. So a bit of difference will be there, come from company to company when it comes to preparation of these notes. But it will give you a good understanding of how this particular is required to be prepared. 441. Yep. Okay. This, yeah. Over here. See, this is again a note forming part of consolidated financial statement. Over here, this is prepared as per the requirements of the Companies Act, Schedule 3, where you are providing about the percentage of holding directly through subsidiaries, country of incorporation. Okay. Plus, there are additional information that you are required to give. As I said, a bit of difference will be there where you are required to provide a net asset, share in total profit, that might already be given over there. But yes, This is kind of the additional information you are required to provide with respect to all the subsidiaries. So you can see direct subsidiaries, indirect subsidiaries, okay. Then they will provide joint venture, joint operations, associate companies. So all these things will be provided over here, and the share of profit and share of percentage and everything we have seen in that particular. So this has been bifurcated in two sections. But this is the information that is required to be given as per the Schedule 3 and the Companies Act over and above the consolidated financial statement. Even when you do not prepare a consolidated financial statement, you are required to present this information. Now, why this is important? Because as an auditor, we need to understand what is our role, what is required to be disclosed and what is not required to be disclosed. Even when the company has an exemption, this is required to be prepared. This is required to be prepared. Okay. So even if you get an exemption, you are required to prepare the details which are given in the Schedule 3 and which are given in the AOC 1. Okay. Now, once we understand what is required to be prepared, what is not required to be prepared, then we can go for the auditing. This is kind of just understanding the provisions of the Companies Act with respect to the group audit. Yes, Samanathan.
Sir, I could remember that in that investment company, when you have the another level of investment company, it is a exception. As per Ind AS 110, the para B we talk about, it's a mandatory. But in
Yeah.
case of that one, the first part, ABC Limited, when here the intermediary subsidiary and the other thing, the four condition is satisfied. In that this case, it is optional. It's not mandatory. That is exemption, not exception, as per Ind AS 110.
Sorry, I didn't get your question. So,
Sir, I'm saying that para 4B is talk about some mandatory as per the Ind AS 110. But
yes.
as per the earlier case, ABC Limited is XOI Limited, it is optional. It's not mandatory. As per para 4.
Rule 4 you're talking about. Rule 6 you are talking about.
I'm not rule 6. I'm talking about Ind AS 110. Para number 4 I'm talking about.
Yes. Yeah. So see, again, now if you want to prepare, you can prepare. Okay.
Yeah, that's what I'm saying. It is optional. In the first case, it's optional. Second case is a mandatory.
Yes, correct. It's optional. Reason because let's say for example, members want to prepare, director want to prepare, then the first class of exemption will not be applicable. You will not never take that exemption. So exemption is kind of a scenario where if you want to prepare, then the first conditions you are not required to satisfy, then you will be basically, you have to prepare then. Yeah. So basically, when I talk about exemption, only when you are going and taking that exemption, then only it will be available. Otherwise, it will not be available to you.
Yes, sir. The first one is a exemption. Second one is a exception. Second case is exception, not
Correct.
exemption.
But there are again scenarios where, see, this is in second case also. When I talk about investment company, okay, para 4B, okay. Now you will say that, okay, I am an investment company, I will not prepare the consolidated financial statements. No one stops you from presenting additional information. Okay, you are required to comply with the Ind AS, you are required to comply with the provisions of the Companies Act with respect to the giving the required information. But if you want still to give additional information, perfectly fine, you can give. So no one will stop you from giving additional information in your annual returns or annual report. But whether you should or you should not, that depends upon the company actually.
Okay, sir. Thank you, sir. I just correlated. See, this is what discussed in Ind AS 110.
Yeah.
In the CFS. That's what I'm recalling and discussing.
Correct. Yes, you are correct. You are correct on that part. That yes, basically, when we talk about a particular investment company, the India says that they are required to measure all their subsidiaries as a fair value. That you are required to do. But in addition to that, if you want to do something else, some additional disclosures, some additional information, you can give. That is up to you.
Right, sir.
Okay.
Thank you, sir.
Okay, so that was the requirement of Rule 6 and Ind AS 110. Now, again, there is some more thing with respect to the Ind AS 110. I will not go into that much detail with respect to the scenarios where even the subsidiaries of the, I think, investment entities are required to consolidate, and there are other requirements. So we will not go to into that particular level of Ind AS 110, but we will stick to the part where the consolidation is now applicable. So apart from these scenarios, let's say now go to the scenarios where consolidation is applicable. So CFS is mandatory, or rather than mandatory, I would say applicable. CFS is applicable. That is something now we need to discuss as an auditor what we should do. Now, when I talk about CFS becomes applicable, okay, the question comes is, we have discussed in the past also, but again, the question comes is, as an auditor, what is your responsibility? As an auditor of the consolidated financial statement, what is your responsibility? So now, let's say, for example, ABC Limited is a parent entity. You are auditor of parent entity. So what is your responsibility for CFS? What is your responsibility in that scenario? Anyone?
So you're talking about the parent company responsibility or auditor responsibility, sir?
Auditor. Responsibility
Oh,
of the auditor of the parent company, because we are the one who is going to audit the consolidated financial statements. Anyone? As a auditor of the parent company, what is our responsibility with respect to consolidation, with respect to the audit of the consolidated financial statement? What are we are required to do? What we are required to do? Come on, guys, pretty much easy.
sir, the thing is that whether that all the component, whether it is included here or not, the first he will check it out. And he will also verify from the how many CFS is reported, the component reported now. The earlier years, how many CFS the component reported earlier? Is there any differences? That also he
Mhm.
has to look into it and he has to verify it. And he has to satisfy himself that all the CFS process as per the financial reporting framework. And
Mhm.
as we studied in that 143 1 also, whether it is the matter of inquiry, and 143 also we will look into it, and the Caro report class 21 also we will check.
Yes, very good. Very good. So, one more thing I would like to highlight, and just for your information, you already might have read about NFRA, Section 132. Yes or no? NFRA.
Yes, sir.
Okay. So, the role of NFRA is to govern the accounting and auditing of the listed entities, and all those entities they are covered. Okay, so I'm not going to the applicability of the NFRA, but let's assume wherever the NFRA has a jurisdiction. Now they have, just for your information, NFRA in 2024 came out with a circular where they describe what is the responsibility of the principal auditor and other auditors in case of the group audits under the rule section 132 2BC and NFRA rules of 2018. So that was the circular which was brought into, and there was some things which were discussed in this particular circular with respect to the requirements of the auditor. Again, now we will not go into much of this circular, but again, there are few things we need to understand. That when you are doing the audit of, like you are the group auditor, or when I say you are the principal auditor, okay, so sometimes you will see that some different type of terminology is used in this circular. For example, group financial statement, GFS, or it can be said as a consolidated financial statement, CFS. Okay, they are same. Okay, so you can say the group financial statement, consolidated financial statement, all those things, but they are the same. So you as a principal auditor, or sometimes it is referred as the parent auditor. Okay, sometimes written as a auditor of the consolidated financial statement. Okay, so you as a principal auditor, what you are required to do is you are required to first of all comply with the SA 600. That is the first and foremost responsibility. We have to comply with SA 600. We have seen SA 600, yes or no? So there was one requirement. So first thing is comply with SA 600. So remember, there was one requirement in SA 600 that we as a parent auditor, we as a principal auditor, we have to assess something, that our own participation is sufficient as a principal auditor or not. Yes or no? Do you remember that part?
Yes, sir.
So our own participation, whether it is sufficient or not. So at that point in time, we discussed in detail that how a principal auditor is required to understand what it does, what is its responsibility. Remember? So I'll just take you to the notes of that particular chapter. Okay. So we discussed this in SA 600 using the work of another auditor, component auditor, parent auditor. At that time, we understood this whole things. And we understood that, okay, acceptance as a principal auditor, that is PA, MACA, that is required to be understood before principal auditor accept its own participation as a principal auditor. That what is the materiality portion, what is the auditor's degree of knowledge, the principal auditor's knowledge, components risk of material misstatement, additional procedures that might be required to be performed. If principal auditor understands this MACA, then only he can go and accept as an principal auditor. So the first responsibility comes as comply with this SA 600. Understand, are you a principal auditor? Can you be a principal auditor? If yes, then the next things come into the picture.
Yes, sir. Also we need to check the independence of the auditors and the ethical requirement. Also, we will call and he will tell the materiality. Also, he will fix and inform to them. If the component auditor is not the CA member in practice, some other person, then that situation is more critical. Then confidentiality also to be checked with him. In addition to that matter.
Yes, but before that, there is something else that we need to understand. Before, see, this is the using the work of another auditor. Using the work of another auditor. And remember, when I said work, at that time we say that opinion issued, testing performed, or specific procedures performed by the another auditor. The work means opinion issued, testing performed, or specific procedures. Now the question comes is, one simple question comes is that when I talk about work to be performed by another auditor, opinion issue to find, they are going to issue opinions. Subsidiary company auditor will issue the opinion. What about specific procedures? Let's say, for example, remember we discussed somewhere that we need to understand that whether their procedures are sufficient or not. If not, then we can send questionnaire, we can visit, we can ask them to perform additional procedures. Remember, we can ask component auditor to perform additional procedures. Plus, we also discussed that we need to coordinate, with the component auditor. We need to make him understand, okay, how your work will be used for our purpose, how your work is relevant for our purpose. The question comes is how we are going to do that. How you are going to use the work, that we understood. But before using the work, how you will reach to that particular stage where you are ready to check whether you can use the work of component auditor or not, or another auditor basically. The question is that how you will identify how many auditors are there, how to reach out to them, what you need to communicate with them, what you need to inform them. When you are starting the audit of ABC Limited, in our question that I'm talking about, when you are starting the audit of ABC Limited standalone plus consolidated financial statement, at that point in time, you might not be having already reports issued by the component auditor. We just have started the audit. Everyone just have started the audit. How you will make sure that you are reaching out to all the component auditor? Let's say, for example, this one. In this particular scenario, we are talking about almost 93 subsidiaries. 93 subsidiaries. How will you make sure that you are not missing out the auditors or out in, auditors, some auditors out of these 93 subsidiaries? How will you make sure that, okay, you are not missing out important subsidiaries out of them? Or how will you make sure that, all the auditors, all the component auditors are in touch with you, they understand your requirements, all the things what you want? In a normal scenario where you have one or two subsidiary, still manageable. I'm talking about 93 subsidiaries over here. How will you do that? What is your responsibility with respect to the 93 subsidiaries? Will you call each and everyone? Hello, component auditor of this entity, you have to do like this.
Firstly, we will ensure all the required subsidiaries are collected together. That is, it is a primary responsibility of the management. However, we need to verify whether all the component are properly included in it by way of last year audited statement and this year what is provided. Is anything is a new investment done or any board of meeting minutes of the meeting, like that we can go on to verify, find out is anything missed or not.
Hmm. Hmm. Okay. What else? Sorry.
Then once the full list is ready, then the consolidation process will begin. That the verification part, the other things, the accounting policy, harmonization, that the reporting period, whether it is their alignment and applicable financial reporting framework they used or not, or the auditing standards they used or different, like that. That actual process will begin.
Hmm. Okay. Yes. Anyone else would like to add to this thing? Anyone else? Okay. So you're correct. Yes. Basically, when we talk about consolidated financial statements, audit of consolidated financial statements, you have to comply with SA 600 to understand whether you are the principal auditor or not. But apart from that, what you are required to do is you are required to understand, identify the components or their auditors which are required to be included in the consolidated financial statements. So first identify the components. Okay. So you need to identify components over here. Identify components to be included. Okay. Second and very important part that we will understand through financial statements. See, these are the consolidated financial statement, and I'll go to a specific schedule of a like notes to account of the consolidated financial statements. Okay. Now, this is the notes to the consolidated financial statements, and this is the part we are talking about segment reporting. Segment reporting. That means it combines the segment of each and every entity together. All the segments together. Let me rotate it for you guys. Yeah. So I'm talking about all these segments which are there, whether from this company, from other companies, all the segments together. So the question comes is that not only the components, but I need to identify segments from these components also. Which are the segments from these components and what is the information? Then only I will be able to prepare segment reporting of the consolidated financial statements. So identify the segments. First identify the component, then identify the segment, then identify the related parties of these components. Why do we need related parties of these components? Reason because another schedule, another particular note I will show you. So we are now talking about again. Wait a minute. Let me go take you to that particular note. So, oh yeah. Now, as we discussed, this particular part, that is AOC1. So, irrespective of your consolidated financial statement, irrespective of your preparation or not, you need to show this information. You are required to show this information. Yes or no? So in that case, how will you get this information? When you are prepared, you are not required to prepare financial statements. Still, you are required to disclose this information. How will you disclose this? There are many other things that you are required to disclose as a part of the financial statements. A lot of informations that usually is not directly available. Why? Because in that particular scenario, if you are doing the audit of a parent company, there is specific requirement. Subsidiary company might prepare financial statement in different way. For example, related party transactions. I'm not talking about the intercomponent related party transactions. I'm talking about related party transactions of these subsidiaries, joint ventures with their related parties. With their related parties, for example, dividend, for example, key managerial remuneration, all those things, a lot of things are there in this. A lot of things are involved in this related party transaction. See, components, compensation of key managerial personnel. So all this particular information you have to obtain from all the components. And this might be an additional information because they might initially not required to prepare all this particular information for their financial statement, or their disclosure level might be different. But you being a listed entity, or you being an entity to which to whom other laws and regulations are also applicable, you need to determine what additional information you are required to disclose from the point of view of consolidated financial statements. And that is something required to be done before start of the audit. Reason because I cannot be standing 2 days before the reporting due date and I came to no. Now I have to disclose this information. Call all the auditors. Auditors, please provide me this information. So what information is required to be disclosed in your financial statement, in your consolidated financial statement, like by management, you should be aware about that. That okay, management is required to disclose this information, and as an auditor, we are required to look into that information, whether this information is correct or not. Are you getting the point? So this particular information is required to be understood from a point of view of like, okay, whether management is required to disclose, and as an auditor, are we required to audit, or is it something additional information? See, this is the part again. Additional information as required under Schedule 3 to the Companies Act of Enterprise, Consolidated Subsidiary, Associate, Joint Venture. Additional information. This is percentage of consolidated profit and loss, percentage of consolidated net assets, percentage of consolidated OCI, percentage of consolidated comprehensive income, and their total amount for all the subsidiaries which are Indian, which are foreign. Again, this is, let me rotate. Yes. All these are subsidiaries we are talking about. And then comes the minority interest. See, minority interest in all the subsidiaries. Again, they could be Indian, foreign, joint operations, joint ventures, associates, again, Indian, foreign. So all these things are already there. Now the question comes is how we are required to understand that whether management is preparing all this information appropriately. So you need to understand the related parties. Which are the related parties? You need to understand what is the reporting requirement. This is very important. Reporting requirement. Okay. And when I talk about reporting requirement, I'm talking about financial reporting requirement. What is the reporting requirement? And are you getting the accurate and complete financial information from components for the purpose of reporting? So complete and accurate financial information from components. Once I get that, not necessary, I will use that information directly. So, for example, these all are foreign subsidiaries. Someone is from Mexico, someone from Luxembourg, someone is from Indonesia, okay, something is from Europe, Nordics, Thailand. Different financial reporting framework might be used to prepare their financial statement. Some might have used IFRS, they might have used their own local GAAP. Okay, again, local GAAP. So how would you ensure that, again, South Africa, a lot of different countries are involved in this. How will you make sure that the financial information that you have received is comparable, is something which is of a similar nature? Australia, North America, Japan, Canada, a lot of countries, and they will prepare the financial statements as per their own local GAAP or IFRS or anything else. Now, you can only consolidate when they are aligned, when they are appropriate, when they are of same nature. What if, let's say, for example, okay, somewhere fixed deposits more than 3 months are not required to be shown as a cash and cash equivalent. It is required to be shown as in loans and advances. Or somewhere it is different reporting requirement with respect to the fixed deposit, even from the day one. So over there, it's not just line by line consolidation that you will do. You need to understand what information you have received, and in that information, what adjustments are required to be made. Now, again, the question is this particular part, that when I'm talking about the adjustments, this is not something that you will make on day one. Oh, sorry, not on the last day of the audit. These adjustments and everything is not something that you will say, okay, I will make this adjustment. Once I'll receive the information, I'll go through the information, and then I'll decide what adjustments are required to be made. Is it so? If that would be the scenario, then you would end up, in particular, what you can say, issue, because the last day, what will happen is now you are stuck. Basically, you are stuck and you have the information, but now you are just analyzing what, adjustment you are required to make. So all these things are required to be planned well in advance. Then only you will be able to understand, okay, you will be able to communicate with your auditor, component auditors, that, okay, these are the things that they are required to basically do. They are required to provide you this additional information. Are you understanding the point? So this is something which is done at the planning stage only. It is not something that you do at the execution stage or at the final reporting stage. No, this is done at the planning stage. At the time of planning only, we have to make sure that we are aware about the reporting requirements. And this is done, whatever additional information you need, this is done based on the group instructions, group audit instructions. Now, what are the group audit instructions? Group audit instructions are the scenario where we send the instructions to the component auditor, that component auditor, this is how your work is required to be used. This is what is your specific areas. This is what is the materiality and all those things. Plus, we send them the questionnaire well in advance to understand what they are doing, how they are doing, what is the additional requirement, everything. So a lot of questionnaires, a lot of information is sent to them to first understand what gap is applicable to them. Second, how they are preparing the financial statement. Third, what they are going to do with respect to the significant risk areas or the significant areas of their financial statements. A lot of things are there that we understand from them, from the questionnaires or from the group reporting instructions. And once we understand that, on the basis of that, we do the planning. We determine whether we need to perform any additional procedure well in advance, or whether we are required to include anything well in advance in our procedures, or we will be fine when they will provide the information. Even at the end of the audit, we ask the auditor to provide a confirmation. So I'll show you something, some illustrative instructions and the confirmations for your understanding purpose. These are illustrative in nature. Okay. See, this is the group audit instructions, which are basically sent by one of the auditor to the component auditor. Okay. This is from the principal auditor sent to the component auditor. Okay, what it includes: scope of the area. Here we are required to, we are asking them to perform a full scope audit of the financial statement in accordance with Ind AS. So whatever gap is applicable to you, you have to perform audit as per the Ind AS. You have to express an opinion. This is a true and fair opinion Means even if your local gaps requires you to do the audit, or even if your local gap requires you to do the review, still you are required to issue true and fair reasonable opinion for us. This is the requirement of Caro that you are required to fulfill. Key deadlines which are required to be met by them. Group materiality which we will give to them. Again, component materiality. This is something we give to them. Small matters below this not required to be reported to us. Significant risk areas, deliverables that we are required to get audit report from you. Group reporting pack with the questionnaire. I'll show the questionnaire also. Memorandum of work, a summary of key audit findings and how significant risk areas were addressed. Management representation letters, subsequent events reviews, and compliance with the independence and code of ethics. A shallow instruction, but in original, the group instructions are much more detailed than this. This is just an overview of it. Like again, this is the questionnaire that I was talking about. Here, component auditors are required to fill like whether they have complied with the independence, whether they understand how their work will be used, whether they complied with the materiality, whether they complied with the SA 240. Okay, then whether they ensured India's 115 areas. These are the significant areas, specific India's reporting areas. Like if we identified any issue in that, or if the component auditor looked into this particular areas specifically. This is something with respect to the intercompany transactions for the adjustments. So they are required to provide this intercompany transaction for the adjustments. Specific reporting for the Caro. If there is any specific reporting from the Caro, we need from them. Subsequent events related. And then the component auditor will sign off. An example, it can be much more detailed than this. Much more detailed. So as a principal auditor, this is our responsibility. This is what we need to do. So, which includes identifying the components, identifying reportable segments, related parties, identifying and obtaining accurate and complete financial information, making appropriate consolidation adjustments, harmonization accounting policies, accounting framework, and gap conversion where applicable. Clear? So this is what a responsibility of the parent auditor is. Any doubt? Any doubt? Okay, if no doubts, let's take a quick 10-minute break. After the break, we'll gather back and discuss some more things with respect to the reporting part and auditing part. Let's take a quick 10-minute break. Nisar ji? Nisar ji? Nisar ji? Nisar ji? Okay. Hello everyone, welcome back. Let's continue the discussion. So what we were discussing is, we were discussing the responsibility of the principal auditor. Okay. Now, we need to discuss some important things with respect to the reporting part. We will come to the auditing part also, how to audit these kind of scenarios. But once we need to also understand how reporting happens. Okay, we will take the example of the publicly available data and we will see how actually the reporting is being done for the consolidated financial statement. When I say reporting, it's the audit report that I'm talking about. How audit report is drafted for a consolidated financial statement. Okay, so that we will see. And on the basis of that, we will understand what is the reporting responsibility of the auditor then. Okay. So we will go to now the audit report for the consolidated financial statement. Okay, this is the audit report for the consolidated financial statements. Okay. The audit report for the consolidated financial statement is also in accordance with the SA700 series that we have understood. So SA700 you have to still comply with. It's not like that we will not comply with SA700. No. Audit report is same, like we have the opinion paragraph, we have the basis of opinion paragraph, we have the emphasis of matter paragraph, we have the key audit matter paragraph, the way it is there. Okay, now the only part will be these key audit matters that I'm talking about are of the subsidiaries and the components. So it is not the key audit matter of only parent company. It includes the key audit matter of maybe subsidiary, maybe joint venture, or whatever we are consolidating. From there the key audit matter can come. So for example, this is key audit matter of a particular group entity. Okay, and how it was addressed. Again, key audit matter with respect to a group entity. So see, this is component auditor. So this is with respect to the component which was audited by the component auditor. Again, this is component auditor of this particular entity. He reported group this key audit matter. So key audit matters will now be coming from the different financial statement audit reports of the component auditors. Other information paragraph, as usual, that we have for the normal audit. Management responsibility, auditor's responsibility will be the same. Only the part change will be that now the responsibility will include that management is also required to prepare the consolidated financial statement. So that will be the part. And again, auditor will be required to issue a reasonable assurance on these consolidated financial statements. Other matter paragraph. This is very important. We have discussed this as accordance with SA 600. So there was one requirement where we are required to report on the components not audited by us. If you go to SA 600, remember we have discussed about the reporting part. That other matter paragraph, we are required to report that when principal auditor relies upon the work of another auditor over there to the extent the financial information of components audited by other auditor, when they are included in the consolidated financial statement, we are required to report that in other matter paragraph. So that is the other matter paragraph over here. Here, we are talking about the components not audited by us and the components which are audited by other auditor. So we did not audit the financial statement of one joint operation whose financial statement reflect this revenue, this much cash inflow and everything. We have discussed in when we were discussed the SA 706 and SA 600 both. We did not audit the audited financial statement of two subsidiaries, 56 step down subsidiaries and everything. So like this way, we have this other matter paragraph in line with SA 600 plus SA 706. That's the one additional reporting part. Number two is the reporting under CARO. We will see what we are required to report under CARO and reporting under 143(3) of the Act. See, 143.3 of the Act will still be applicable on the consolidated financial statement. Okay. So we are required to report as per the 143.3 on the consolidated financial statements also. It's not something that we are not required to report. So we will be reporting under 143.3 everything the way it is there based on the opinion and information we have received. Okay. And the same is reported over here. For example, one point, provisions has been made in consolidated financial statement as required under the applicable law for any material foreseeable losses, including long-term derivative contracts. Now, to report on these points, whether it's the material foreseeable losses, whether it's the amount being received from the step-down subsidiaries or something like that, or for example, accounting software used for maintaining general ledger, okay, and other papers electronic mode has not been kept in servers physically located in India on daily basis, all those things under Rule 11G that we have already seen in our report. Okay, when we discussed SA 700, at that point in time we discussed the reporting under Rule 11G, all the points. So the question comes is that how we are going to gather this information. We are going to gather this information through the audit instructions that the component auditors are required to provide this additional information to us, and we are required to then validate and accordingly report this particular information in the audit report of the consolidated financial statement. For example, this one. Now, how will you understand, let's say, for example, a company which is there in the South Africa, which accounting software it is using, whether the servers are located in India, whether it is not. So in case of one step down subsidiary company, we are unable to comment whether the backup of accounting software, which form parts of the books of accounts, have been kept on servers located in India or not. Or, like this way, we are required to report on all the matters for all the subsidiaries, like in the consolidated financial statement level. And for that, you need to obtain the details from them. For example, adequacy of internal financial controls with respect to the financial statements, which is given in Annexure B. Now we are required to report from the consolidated financial statements point of view. You need to obtain additional information. Then only you will be able to report on that. Otherwise, how you will report? Even disqualification of directors, whether it is associate, group companies, joint ventures, joint operations, in terms of section 164 subsection 2, only when you are getting or receiving information from the subsidiaries and components or to that extent, then only you will be able to report that particular part. So reporting on these matters will still be applicable, but the question is that we are required to get that information from the component auditors. For example, audit log, edit log, or audit trail feature. Now, this feature may not be available outside India in the subsidiaries. How will you comment on that? Whether they are maintaining this or not? So, like this way, it becomes very difficult, to audit or to provide this information if you don't have this information. That's why, as a principal auditor, as an auditor of the consolidated financial statement, we have to plan all these things well in advance. So when we talk about reporting, we have to report on all these matters. This will be applicable to us. We have to provide attention to the additional reporting matter. Okay. So that is the main and important part that we need to understand. Now, there could be a scenario when the parent auditor is the auditor of its components. If the parent auditor is the components auditor of its component, then it will not be an issue because parent auditor already knows what is the scenario, what is not the scenario, what he needs the information, he will prepare accordingly. But when the parent auditor is not the component of it's not the auditor of its component, at that point in time, the parent auditor has to include that paragraph that, remember, SA 600 or 706 paragraph that we are required to, that we discussed just now. So that becomes very important. When the parent auditor is not the auditor of its component, you are required to include in this one, when the parent auditor is not the auditor of its solid component, include this paragraph as per SA 600. Okay. Prescribed as per other matter paragraph, that you are not audited this particular part, you have relied upon the reports that you have received from the other auditor. When the accounting framework is different of the component from the parent, you have to convert them as as a principal auditor if component auditor is not converting for you. Otherwise, you may parents management may perform a conversion and you can validate that conversion. See, again, that depends upon who is performing what based on the scope of the work. But usually what happens is parent management is the one who performs the conversion if that is into the other gap. You perform the conversion to validate that the conversion which is done by the parents management. So let's say one entity in Japan, it is based on the local gap. Parent management will convert you in the Ind AS. Now you have to understand how the conversion is done, or you may need to re-perform that to understand whether the conversion is done appropriately or not. Then only you will be able to comment, okay, whether the consolidation is appropriate or not. So when there is a different accounting frameworks involved, conversion is required, or at least understanding of the conversion is required by the principal auditor. Then only you will be able to comment whether the conversion is appropriate and the numbers which are used then from converting from the US GAAP, local GAAP, IFRS to the Ind AS is appropriate or not. And that may include passing some adjustment entries. So parent management may pass that adjustment entries. You as an auditor have to audit those adjustment entries. Otherwise, you will not be able to understand what adjustment entries and how the numbers have been derived from. Now, what you will do, a question to all of you, what you will do when the audit is performed based on some different standards. Let's say, for example, a particular country where the auditor is required to issue review report instead of audit report. So let's take one example. Let's say ABC Limited is there. It has one of these subsidiary somewhere in let's say D country. Okay. Where auditor has issued review or kind of limited assurance report. Okay, review or limited assurance report. Okay, for the purpose of their whatever review they were performing. This is as per the local requirement. Now, how will you use this report for the purpose of consolidation? How will you use this report? Can anyone tell me how you will use this report?
Yes, sir. It has to be converted as per the local gap adjustment. That we will ask the management to convert it. If they are not doing, then the CFS, the principal auditor, will do that. Otherwise,
Okay.
if that issuing person itself is able to convert that, then that's okay. That is a first option we will give. Then that is not possible, then we will ask the management. Otherwise, we will, as a auditor, will do the conversion.
Okay. Can you convert a limited assurance report into the reasonable assurance report? Can you convert that? See, I can convert a financial statement which is there in the IFRS to the Ind AS by passing adjustment entries and preparing, let's say, a new set of financial statement as per the requirement of Ind AS. But is it possible to do for the assurance reports? Is conversion of assurance report possible? Anyone?
Only limited to limited, sir.
Only limited to limited. If that is the case, then can you convert limited to reasonable assurance? Is it possible to convert limited to reasonable assurance? No. That's where, remember, we discussed audit instructions. So these instructions come into the picture because at that time only we asked them to issue reasonable assurance. I cannot convert limited assurance into a reasonable assurance. That's why I asked component auditor to issue a reasonable assurance. Now the question comes is, what if component auditor denies to comply with the instructions? What if the component auditor says, I'll not issue reasonable assurance? I'm not getting, engagement of reasonable assurance from management. Component management is not allowing me. The component management who has hired me or, appointed me only for review. I cannot issue reasonable assurance. What you will do? Anyone? So the component auditor says, sorry, I cannot issue reasonable assurance, not possible for me because management has hired me only for the review. Management has not hired me for the reasonable assurance report. I cannot overstep my engagement. So we cannot issue our report. See, in that case, there are two things. One, either you perform the procedures if you are able to. Number two, if you are not able to perform the procedures, it will be limitation on the scope of audit. You may qualify if that is a material portion. Simple. So when in this particular scenario, if this limited assurance report is there, if auditor is able to provide, now from here it will be two things. If component auditor is not able to provide reasonable assurance report. Okay. In that case, as a principal auditor, okay, as a principal auditor, perform additional procedures. If not able to perform, then qualify. If material. And if material and pervasive, then simple, adverse. See, either I am able to get the information or either I am not able to get the information. There is no third scenario to that. If the component auditor cannot perform, I will perform. If I cannot perform, I'll qualify, modify my opinion. If it is material pervasive, I issue an adverse opinion or maybe disclaimer for opinion, depending upon the limitation. So in that particular scenario, I need to understand what is my role. I'll give you one more scenario. Let's say ABC Limited component, let's say D company of some other country, auditor of D company, as per local auditing standards. As per local auditing standards. Okay. There is no requirement to consider subsequent events. Now what you will do as a principal auditor, okay, you are the principal auditor. How you will tackle this scenario? How you will accept this report? Let's say this particular report that I'm talking about, as per local auditing standard, this report is a reasonable assurance one. Reasonable assurance report is there. They have reported true and fair view, but there is no requirement to consider subsequent events. How will you tackle this scenario? What you will do in this scenario? Anyone? Anyone? How will you refer to this, or what you will do in this scenario? Come on, guys, quickly. Pretty much easy. Trust me. No? See, in this particular scenario, it's same. If
Sir,
the
please repeat the
auditor,
question, sir. I lost my connectivity.
so the question is, in this, if a company is there which is outside India, subsidiary, okay, this subsidiary is outside India, D company. The auditor of D company, as per local auditing standards, when issued the reasonable assurance report, there was no requirement to consider subsequent events. He did not consider any subsequent events and issued a reasonable assurance report. That report is provided to you as a principal auditor. Now, how will you deal with that report?
Okay, and then if the Indian as per the Indian accounting standard applicability is there in that particular subsidiary, then it has to be updated, and then only it has to be used. In that country, in the foreign country, if that particular item is not considered as a subsequent event, then that's okay. But as far as the Indian accounting, Indian standards on auditing is required, auditing framework, then it has to be updated as per the Indian standards on auditing framework. Then only it has to be concluded by the parent company.
But as a principal auditor, you will perform procedures?
Yes, definitely. See, first we will request them to do it. If they are not able to do that, then as a principal auditor, he has to do that.
Correct. Very good. Yes, absolutely correct. As a principal auditor, you will ask them, provide them the instructions. You need to consider this particular standards. So remember, I showed you the instructions over where we ask them to comply with the independent score and code of ethics. You can have a scenario where you can add standards. Okay, these are the standards you are mandatory required to comply with. Auditing standards, you need to perform this auditing or reporting as per this. If your local standard does not include these requirements, then still you are required to additionally perform these procedures. You can add up in your instructions. Now the question is, what if the component auditor denies? In that case, you as the principal auditor can perform additional procedures. If you are not able to perform additional procedures because of the limitations, simply I will modify my opinion. And that is a scenario. See, I'll show you in the audit report. Over here, yeah. See, here in one of the step down subsidiary case, we are unable to comment whether the backup of the accounting software which forms part of the books of accounts and other relevant books and papers in electronic mode has been kept on servers physically located in India on a daily basis. The auditor did not report. We were not able to get the information. At the end, we qualified the OP. Simple. We included into qualification that we are not able to comment. So, except, see, in our opinion, books of accounts as required by law has been kept so far in from our examination, except this is the qualification. Similarly, a lot of places where you are not able to comment, you will say that you are not able to comment on that. So, for example, in one of the joint ventures, the features of recording audit trail is not enabled for the direct changes to the data when using certain write accesses. Qualified. So, by this way, if you are not able to get the details of the particular additional reporting requirements, in that case, you may either perform the additional procedure. If you are not able to perform the additional procedure, okay, in that case, you may qualify. You may specifically point out that, okay, we are not able to perform the additional procedures. As a result, we are not able to comment on this. For example, I will show you something. Let's say, for example, let's say if there was a qualification with respect to any of the point with respect to the financial statement, which was material, then this opinion paragraph, your opinion paragraph would have converted to the basis of qualified opinion. And here you might have, you would have, issued a basis of qualified opinion over here. And you would have specified that. Okay. So that's how you need to consider whether you are able to get the information or not. If not, then are you able to perform additional procedure? If not, then qualification. Clear? Any doubt? Any doubt? Okay. Now, what if any component is not audited by an auditor? Means there is no audit requirement in that local jurisdiction. How will you deal with that scenario? Let's say, for example, this same example, I will take it up. Okay. Let's say D company. This was there, D company was there, or whatever you want to name it. Let's say ABC Limited, and we have, let's say, K Limited or K company, whatever. There is no local requirement for audit. No local requirement for audit of this entity, which is outside India, basically. This is outside India. So there is no audit requirement. So management of K company gave you the financial statement. So management of K company directly provided the FS. FS prepared by management of K company. And this is then provided to you as an auditor, principal auditor. There is no component auditor in the picture. No component auditor. How will you deal with this scenario? There is no audit report because there is no requirement for the audit of this kind of company in that local jurisdiction of that country. How will you deal? How will you deal in this scenario?
Sir, here in this case, the other matter paragraph he can put very clearly this component is not audited as per things. However, he has to that gap adjustment, all these things, harmonization of accounting policies, and the reporting period adjustment, all these things he has to look into and do that.
Yes, very good. But just one question. If, let's say, for example, if this is not audited, can we rely upon this financial statement? If this is not audited, can we rely upon the financial statement? Yes, Ayush, we can ask management to get account audited, but let's say management says there is no requirement for local audit, and hence no local auditor is required to audit their accounts. And sometimes, it becomes very complicated due to language challenges to perform the audit of that particular company or the accounts of that company, which are maintained in the local language, which you cannot understand. It's not English, it's a local language. You're not able to understand the records, the financial statements, and everything. How will you, as a principal auditor, deal with that financial statements? Management, let's say, may convert into the English, may translate into the English. Let's say you don't have basically resources to, kind of for the purpose of conversion. Chinese, Japanese, or different 10 different languages are there. Might be we don't have the appropriate people to understand the financials in that language, or transactions, underlying documents, invoices, receipts, bank statements. How will you do the audit? Or how will you rely upon the financial statements? What you will do? Anyone? See, in that particular scenario, two things are required to be done. Number one, always check the materiality, whether the portion which is not audited is material. If it is material, and if you are also not able to audit because of the limitations in the scope of limitation in the scope, then you have to qualify. But if it is not material, then I'll show you an example. Let's read this particular paragraph. The financial statements of financial information of 3 subsidiaries, 6 step-down subsidiaries, whose financial statements reflect total asset 1250 crore, total revenue 539 crore, net cash flow 34 crore, okay, have not been audited either by us or by other auditors. The consolidated financial statement include group share of 127 crore as on 31st March. Okay, not audited by us or by other auditors. These information or this unaudited financial information have been furnished to us by the management. Our opinion on the consolidated financial statement insofar relates to these amounts and disclosures, okay, in terms of 143 is solely based on such unaudited financial statements. In our opinion, according to information explanation given to us by the management, these financial statements are not material to them. That's why we are not modifying our opinion. If this was material to the group, I would have modified my opinion. Simple.
Sir, excuse me, sir. Please go back. And what are the three items to be reported? That net asset, cash
So
flow,
you need to total assets,
total
okay,
asset.
total revenues, and net cash inflow or outflow, whatever it is. As per this is reporting as per SC 600 only. So if the component is not audited by any of the auditor in that scenario, if it is material, ask management to get it audited. If still they are not able to get audited, you audit. If you are still not able to audit because of the limitation in the scope, sometimes the local law does not allow outside auditor to access the accounts. A lot of jurisdictions are like this way. In that case, if it is material, we will qualify.
Is there any
Clear?
percentage to the total value whether need to be given? Something else?
That you will give percentage when you will specify. Remember, as I disclosed additional information for Schedule 3.
Yes,
Over
yes.
there, we specify, management specifies the percentage.
In this situation, it's not provided. That's what I'm reading that.
Not here, but it will be in that additional information.
Oh, okay, okay, sir.
Because this is reporting as per SA 600. SA 600 requires total assets, total revenue, cash inflow.
Where we have to report in the management responsibility report, or where it is to be reported that the
Financial
percentage?
statement. So remember, we discussed one of the section in the financial. Let me show you again.
Immediately unable to link it.
Let me show you the section of the financial statement. Just give me a minute.
Yeah, I could remember you have shown to us.
Yeah. Just a minute. Let me open it again for you. No, this is a segment reporting. Just a minute. Let me open for you again, and then I'll show you. But yeah, there is a section which is for the Schedule 3 additional reporting under the Companies Act in financial statement. A lot many reporting, but there is a separate section on that. Yeah, here it is. So this is the additional information that required under Schedule 3 under Companies Act. This will include all the subsidiaries and their percentage. Percentage as a consolidated of net asset, percentage as a consolidation of net profit and loss, OCI, other comprehensive income, everything. So you have this percentage available, and then on the basis of that, you can identify, okay, which is that entity and what it makes the percentage of.
Okay, sir. Thank you. But as per SCS 600, we need to tell what is a net asset, what is a net revenue, what is a net cash flow.
Yeah.
That's it.
Yes. So that is a scenario when basically we were talking about that audit is not done of the component. Component is not audited. Clear?
Yes, sir. Clear, sir.
Okay. Let's go to the study material. We'll quickly go through the study material now. We have discussed a lot of things from here, and now we will discuss that. See, responsibility of the auditor for the consolidation. We discuss about section 129. Okay, for the consolidation and the responsibility, we have discussed that. We have discussed that auditor is required to comply with all these matters of 143, 143J, we just now saw, your audit report will not change. You are required to report on that. Audit considerations, as we already discussed, that when you are doing the audit of a consolidated financial statements, you are required to consider the different accounting policies, significant transactions. You are required to consider different adjustments that is required to be made to consolidate the financial statement of the component. Okay. Second, you need to assess whether the work which is performed by the component auditor, on that work, would you be able to express an opinion, or you need to perform something else, or whether your own participation is sufficient or not. So this is something we have already discussed in SA 600, the 4 points. Remember, PA, MACA. Then SA 600 again, we discussed that SA 600 portion. Auditing the consolidation. When we are auditing the consolidated financial statement, so as I said, we need to understand what are the things we are required to consider before start of the audit. So you need to determine the program, what audit program you will be making, nature, timing, and extent of the audit procedures, risk assessment, so that we can include that in the instructions. Determine the extent of the other auditor's work, like what you want him to do. Coordination with the for the work to be performed. You will send the instruction, will keep the update calls, you will discuss with him all these things that we are required to do along with the audit. It is not something that we do at the end, but throughout the audit, from the start, from the day one, we should be aware what is required to be done for the purpose of consolidation. Again, as we already discussed, working papers, what is the procedure for identification of various components, inquiries, investment of parent, joint venture, joint arrangement, all these things we are required to look into. This is the exemption that we have already discussed of the Ind AS 110. Again, this is the exemption for the consolidation. We have already discussed this part. Yeah. Now, there are two types of adjustments that we are required to make, or management basically makes in the financial statement. One is the permanent consolidation adjustment. You might have already seen in the financial reporting part that the adjustment that is made at the time of acquisition. You create a goodwill or capital reserve. You determine amount or equity attributable to the minority and non-controlling interest. That's the permanent part. That's a permanent adjustment. That remains the same. Why permanent? Because once you determine, it will be every time that way only. Then the second type of adjustment comes is a current period consolidation adjustment. Now, what are the current period consolidation adjustments? They are pretty simple. They are the intercompany transaction, intra-group transactions, unrealized intra-group profits, intra-group indebtedness, loan provided by one company to another company. So all those things. Yes, Saminathan.
Sorry, in the September 2025 examination question, I have seen that at the goodwill, what is the, whether it is a permanent consolidation adjustment or current period consolidation adjustment, like that particular question has been asked.
Yeah. So again, so when it comes to the goodwill, when it comes to the capital reserve, they are the permanent consolidation adjustment. So that's why, like as I said, there are two types of consolidation adjustment, and one is permanent, one is current. And it's relevant because as you are also saying that the question is there in the exam. So you need to understand what type of consolidation adjustments are of which nature. For example, when I talk about goodwill, capital reserve, which do not change, they will go into the category of permanent. Pre-acquisition reserves, pre-acquisition related things that you adjust once, and on the basis of that, every time when consolidation happens, you keep that same. That's the permanent one. Current one, which change from year to year, which are based on either on harmonizing the different accounting policies which are used by the component and the parent auditor, harmonizing the financial period, recognition of the subsequent events if they have not considered, intra-group transactions. Okay, all these things are current because they change from year to year. Their value will change from year to year. So based on that, you need to understand whether it's a permanent or it's a current, and accordingly you need to audit that particular portion. Clear? Then you need to obtain management representation. Again, everywhere will be there because we are complying, we are doing the audit. Management representation will be there. You need now reporting part. As I said, SA 700 series, whether it's 700, 705, 706, all will be applicable along with SA 600. So whatever we have discussed in 700, 705, 706 will be there as we saw in the audit report. And the scenarios we also discussed. When the parent auditor is the auditor of all the components, not an issue. You are the parent, you are the auditor of all the components, you know what is required to be done, you will perform audit accordingly. When the parent auditor is not the auditor of its component, instructions and additional reporting as per SA 600. When the component auditor report on the financial statement under accounting framework is different than of parent. So someone is using US GAAP or IFRS or local GAAP. Component is using. In that case, management will perform a conversion. You as an auditor will look into that conversion, and the conversion adjustments are audited by the principal auditor. If you are able to do that, fine. If management is able to convert, fine. If no conversion is possible, management is not ready to convert, you are not ready, you are not able to audit because of that qualification. Then when the component auditor report under an auditing framework different than the parent. So if the auditing framework that is used by the component is different, in that case you have to maintain consistency in the audit framework. You need to ask that particular auditor that please audit as per the standards which are, in line with our Indian standards, Indian auditing standards. Otherwise, what you may ask them, okay, you may also ask them, okay, you audit under Indian gas or as per the Indian standards on auditing. So you are auditing for your local GAAP, fine. Audit additionally for us also. So the component financial statement should also be audited under a framework that is corresponding to the Indian gas. If that is possible, fine. Otherwise, I will say it's not audited. Or I am not able to rely. Again, it will be a limitation. And if the component is not audited, then you need to consider possible modification based on the materiality. Is it material component? What is the materiality involved of such unaudited portion? Is it material pervasive or not material? Accordingly, you will apply SA 705 and you may issue a modified opinion. Clear? Any doubt? Any doubt with respect to any of the part that we have discussed? Any doubt?
No, sir. Clear, sir.
So basically, this was your chapter number 13, group audit. Now to practice this, we will see some questions on this topic. Okay, and we will try to solve these questions. Again, these are, when I talk about group audit, it is not something different than the standards. A question on SA 600 can be on group audits and the SA 600 and the standards together. So you may not have a separate question. The way consolidation adjustment, goodwill, you have a separate question. You may have a question on SA 600, which can also be on the group audit. So you may not have a separate question, but when a question comes on the consolidated financial statement, or when a question comes on the principal audit, or when a question comes on SA 600, there are things you might also need to apply from the group audit chapter. that consolidation adjustment, harmonization of the accounting policies, requirements of the companies that we have already discussed. So let me discuss one particular question for you guys. Okay. Now this is the question is detailed case study based question. Okay, detailed question, case study wise. There is a case study which is there, and then there are multiple questions to that, multiple MCQs to that. This will really help us to understand the topic, and this will really help us to understand how actually different scenarios are catered to. Okay, so the question is, ABC Limited acquired 75% of the equity shares of PBC Limited and DBC Limited on 31/5/21. On 30/6/2022, ABC Limited also acquired 100% equity stake in A&O Limited, Cyprus. ABC Limited was fully owned subsidiary of XYZ Limited. XYZ Limited was engaged in manufacturing of construction equipments and heavy automobiles. While preparing the consolidated financial statement for XYZ ABD Limited, statutory auditors identified the following thing. The inventory valuation, inventory provisioning accounting policy followed by XYZ, ABC, PBC, and DBC Limited was different than the accounting policies followed by A&O Limited. As per Ind AS 1110, consolidated financial statement, if a member of a group uses accounting policies other than the adopted in the CFS for the transaction and events in the similar circumstances, appropriate adjustments are made to the group members' financial statement in preparing the CFS to ensure conformity with the group's accounting policies. Hence, management of XYZ passed adjustment to align the different accounting policies in the consolidated financial statements. The financial year of A&O is a calendar year, Jan to December, whereas the rest of the companies have 1st April to 31st March. ABC XYZ Limited appointed CKC and Company Chartered Accountants as their statutory auditor, where PBC and DBC appointed NKL Company as their statutory auditor. However, A&O was not audited by any auditor. ABC Limited's prime objective was to invest the funds of its shareholders for the purpose of capital appreciation and investment income. Following is this extract of the financial statements of all the entities: XYZ, ABC, PBC, DBC, A&O. Okay, this is the total revenue. CKC computed the consolidated materiality at the 5% of total revenue of XYZ Limited. That is 51.25 CR. That's the consolidated materiality. Based on the above information, kindly answer the following questions. Now, we will see the question and then we will go back to the scenario again for further reading. So, the first question. CKC were of the opinion that they are required to prepare consolidated financial, they are required to audit consolidated financial statement for ABC and XYZ Limited. However, the management of XYZ Limited contended that they should prepare the consolidated financial statements of ABC Limited and it's an investment company. Kindly guide the CKC with respect to the applicability of the consolidated financial statement. So you need to determine first by going through this particular case scenario, whose responsibility it is to prepare the consolidated financial statements. Take a minute, read the question again, and then tell me whose responsibility it is to prepare the consolidated financial statements. Okay. I hope you have gone through the question. Now tell me whose responsibility is it to prepare the consolidated financial statements.
Sir, XYZ.
XYZ, okay. Anyone else? XYZ, okay. Yes, Geeta, it's yes, Hetal, it's management responsibility, but which management's responsibility? XYZ, ABC, PBC, DBC, ANO, there are multiple companies involved. Whose responsibility it is to prepare the consolidated financial statements?
Sir, here overall looking ABC Limited have that PBC Limited and DBC Limited and ANO. All are fully subsidiary for ABC Limited. And ANO Limited having subsidiary for XYZ Limited. This is overall structure.
Why two companies cannot prepare the consolidated financial statement? Why only XYZ?
Sir,
Why
here
can't
I am.
ABC?
Sir, here ABC and ANO is responsible to prepare it. Two company.
Okay.
But suppose if the ANO, as per the exemption we have seen it, if the ANO is in the process of listing, not in the listing or something else, we have studied security and ABC is limited already consolidated. Then if the other stakeholder no objection certificate is received, then ANO is not needed to prepare it.
No, see, again, ABC holds into PBC and DBC. ABC
Correct.
also holds in ANO. ANO is not a holding company.
ANO is a 100% subsidiary company of ABC.
So ABC is a holding and the ultimate
ABC
holding
holding
is a XYZ.
Sir,
XYZ.
see ABC having three company altogether. BBC 75%, DBC 75%, ANO 100%, full stack. And ANO is having subsidiary of XYZ, 100% stake.
No, ABC is a fully owned subsidiary of XYZ. In the question, again, see, the question is simple. So I'll prepare a chart for you. How the chart is, ABC had three companies, which is your PBC, DBC, and ANO. And ABC was fully owned subsidiary of XYZ Limited. So XYZ is here, which is the fully owned, like ABC is a fully owned subsidiary of XYZ. So this is the ultimate holding or parent, you can say. This is the intermediate holding or parent, and then these are the subsidiaries. My question is that why only XYZ? Like most of you have already answered, XYZ Limited is required to prepare the financial statement, consolidated financial statements. Why not the intermediate holding company is required to prepare the consolidated financial statements?
Sir, XYZ and ABC both has to prepare.
So that's the question. Why only XYZ? Why not ABC? So you are saying both. Anyone with the both?
No, sir. As per para 33, ABC is not required to prepare consolidate.
Sir, in this case, very clear. If the as per the para number 4, if these three entity is given the no objection, and the XYZ Limited is fully preparing the CFS, and the ABC Limited is not in the process of listing the securities. If all these conditions are satisfied, then ABC Limited is not required to prepare. But in this question, it is nothing is given. But only one company is investment company, somewhere is given. Only that
That is ABC Limited is an investment company. So para 33 is applicable.
Yes. So again, ABC's prime objective was to invest the funds of its shareholders and for the purpose of capital appreciation and investment income. That makes the ABC Limited as a investment company.
Yeah, then in this case, that para number 4B will applicable.
Yes. So ABC is exempted because it's an investment company. ABC is not required to prepare the consolidated. Only XYZ is required to prepare the consolidated financial statements. So, okay. And as a result, in our question, okay, as a result, CKC was saying that, okay, no, we need to prepare for both. Management says you need to prepare, you need to only audit for XYZ, not ABC. So the management is right. Auditor was saying that ABC and XYZ both. Management was saying XYZ. So in this scenario, management is correct. Auditor, the company, the management of XYZ or the management of ABC, they are not required to prepare consolidated financial statement for ABC. They are only required to prepare for the XYZ and CKC, being the principal auditor, is required to audit CFS of XYZ Limited, not ABC. Clear? Why ABC will not be there? So question also said that ABC is an investment company. That's why ABC is being exempted.
So auditor is also a voluntary prepared CFS to the for the ABC Limited.
To prepare the CFS, in that case, again, the discussion that we had, as pointed out also by the Samanathan, that is a permanent thing that you need to comply with. For example, you need to make sure that you comply with Ind AS 10 and you do not prepare on the consolidated basis the financial statements for the investment entity. Investment entity is required to measure its subsidiaries at the fair value through profit and loss account in accordance with the Ind AS 109. If you prepare CFS, fine, but you have to simultaneously also prepare another statements in the financial statement, which will be audited by the auditor, which will be on the basis of Ind AS 109, where the subsidiaries are measured at the fair value through profit and loss account. So one thing is required to be compliant, that is, you need to measure subsidiaries at the fair value. Okay. Apart from that, if you want to disclose anything additional, you can.
Okay.
Okay. Second question. This is pretty much easy. That is, I would say this second question is pretty much easy. CKC were of the opinion that there is no need to audit the adjustment passed in the consolidated financial statement for different accounting policies pertaining to the valuation of inventory and provision, as this is not part of the original financial statement. Kindly guide with respect to the audit requirement for the consolidated financial statement. Simple, straightforward. So I'll go back to the question again with respect to the inventory provision one. This is the inventory provision point. So auditors were of the opinion that this is not required to be audited. Now you tell me whether this is required to be audited or not required to be audited.
If it is material, then required to audit.
Okay. Anyone else?
Sir, well, it is a harmonization of accounting policies that is has to be aligned with first.
So it is required to be audited, yes? Or no? It's pretty simple, straightforward. Trust me, pretty simple, straightforward. Very good, Hetal. Yes, it is required to be audited. This is the adjustments. Otherwise, how you will make sure that all the financial statements are of the similar nature? And how will you perform the consolidation?
Yes, sir.
That's why I have provided in the question itself. This one. This is the policy. This is as per the Ind AS. India says that
Yes,
make
sir.
the
It has to be
adjustment.
matched as per the holding the money,
So you are required to
parent
make
company.
adjustment. Management is required to make adjustment, and you are required to audit the adjustments. Straightforward. So then the question comes is, how will you audit the adjustments? Can anyone tell me the audit procedure for the adjustments? How will you audit the adjustments?
That audit procedure, we need to check that accounting. When there is a changes in accounting policies, we need to see the retrospective of it, not the prospective of it. Then, as far as possible, they have to go back till the data is available. They have to change it and bring into the position. Even this is saying that the India is 8 also it's talk about this. Wherever the possible data, wherever we have to go back and we have to do the retrospective effect and we have to change it and modify it. Then we have to bring into as per the parent company harmonization.
Okay.
The adjustment is needed. Then the auditor has to look into that whether the management has appropriately changed or not, whether that assumption is proper, calculation is done correctly, whether that is incorporated or not. And in that line, he has to verify it. The data whether used is appropriate or not.
Yes, very good. Yes. So when we talk about the adjustments, it's the current adjustment, correct? It's a current consolidation adjustment, not the permanent one. If
Yeah,
it is a
it's a
current
current period
current period
adjustment.
consolidation adjustment, if it is a current period consolidation adjustment, verify what is the basis of the current period consolidation adjustment. Okay, determine that, okay, like this was the particular policy and this is the applied consistency or not. So let's say, for example, inventory valuation, is the policy being changed in the current year, or it is being changed, or it is being followed since previous years also, whether the consistency is there or not. See the requirement of the applicable accounting standards. What is the requirement of the applicable accounting standard? Then look into that, okay, what is the source of the information? Again, when I talk about auditing, SA 500 will be applicable. Yes or no? I will see the source of the information, from where the information has been gathered, whether it is prepared by the management expert. What is the basis of that information? If any assumption has been taken, then what is the basis of that assumption? So you may write answer by referring to SA 500 also. Because when I talk about auditing an adjustment, I'm talking about auditing a transition. And when I talk about auditing SA 500, will be there. Yes or no? You will see whether it's a, whether there is any risk of fraud or not. You will check whether, any management expert is involved or not. If management expert is involved, then what is the experience of management expert, competency, capability, all these things. So accordingly, you need to answer the question based on, the information available. Clear?
Yes, sir. Yeah, we have
Okay.
discussed overall, but what is the ask of the question? The option when you see it may be different. But it's good that we have discussed everything.
Yeah. Like question, like basically these are the MCQs. So you have the options available. Okay, like we have discussed the answer, so it is the same one. Okay. Now there is one more question that I want to discuss, very important one, which is respect to the reporting part. Okay. So this is the question that CKC and company reported the following para in their audit report for XYZ Limited under XYZ Limited CFS under the other matter paragraph. We have audited the financial statement and other financial information in respect of 4 subsidiaries whose financial statement include total asset of this crores at that March, total revenue of this crores, and the net cash outflow of this for the year ended on that date. Kindly guide with respect to the reporting requirements. Now, this is the paragraph. Again, I will take you to the point where of the question is there. Okay. This is the question. You need to refer to this point. Read this point. I'll give you a minute. Read this point. This one. Okay. Now, based on this point, you need to answer the question. I'll take you to the paragraph again, which was reported. And then on the basis of that, you need to answer whether this paragraph is appropriately drafted or not.
No, this is incorrect, sir. So only the thing is that the component which is not audited, for that case only we have to give this information, not for
Okay.
all this information.
Okay.
This is the report. This paragraph is incorrect.
So we have to specify only the portion which is not audited.
Yes.
Okay. Anyone else? With some different answer? Anyone? With some different answer? No? Don't you think that we need to write about these subsidiaries which are audited by other auditor? Remember that we discussed about this paragraph as per SA 600. I'll take you to that particular point again, where we discussed about, okay, the subsidiaries which are audited by other auditor. For that also we are required to mention. See, we did not audit the financial statement, financial information of 2 subsidiaries and 56 step down subsidiaries. Okay. And these financial statements have been audited by other auditors whose report has been furnished to us by the management, and our opinion on the consolidated financial statement insofar relates to these amounts and disclosures included in the respect of these subsidiaries, step down subsidiaries, joint ventures and associates, and our report in terms of 143.3 insofar relates to these aforesaid subsidiaries, step down subsidiaries, joint venture, associate is based solely on the reports of other auditors. So in our question, here we are saying we have audited. Don't you think this is wrong? We have to divide this in 2 paragraphs. Audited by other auditor and not audited. And don't you think there should be a modification if something is not audited? Why there will not be a modification? Anyone? So see, this is these ABC Limited, XYZ Limited were audited by CKC. PBC, DBC were audited by NKL, and ANO is not being audited. So this is CKC, this is NKL, and this is not audited. Don't you think I should modify my opinion because it is not audited? Yes, no? Yes, no? Come on, guys. Okay. Very good, Ayush. So the modification depends upon the materiality. Remember, we discussed if that is material, then only I will modify it. My materiality stands at 51.25 CR. Is it material? The portion which is not audited. Is this portion material? Answer is no, it is not
No.
material. If that is not material, I may not modify my opinion. I will modify the opinion when it is material to modify. Clear? I may, also compute a materiality at the ANO level. If that materiality is also below 12, then yes, I'm not required to modify my opinion. In front of where total assets of 1235, cash outflow 90, total revenue of 1025, 150, 650, 1650, 3500, 12 CR, 15 CR might not appear material. So based on the materiality, you need to take the decision whether this portion is material or not. If material, then modify. If not, then do not modify. And that is your professional judgment. Remember that.
So before given modify, principal auditor can audit or verify this component.
If possible, if you can audit, if you can perform additional procedure for auditing, fine. But a lot of times it becomes difficult, or not difficult, I would say not possible for the auditor. Okay, difficulty is separate thing, but not possible reason because of the different jurisdiction. So see, in this example, I am specifying different jurisdiction. Sometimes the local law or regulation does not allow outsiders to audit the financial statements or access the financial statement or something like that. So in that case, it may become a problem. If you can audit, if you can then audit and issue an opinion, fine. If you cannot, then you need to consider materiality. Clear? Any doubt? Any doubt? Okay, if no further doubts, then can we quickly take up 5 MCQ as a part of the quick revision? Okay, let's take up quickly 5 MCQs as part of, what you can say, quick revision that will help us to understand this particular topic. Okay, just a minute, let me bring up that MCQ. Okay, first question. Who is responsible for the direction, supervision, and performance of the group audit engagement? Who is responsible for the direction, supervision, performance of the group audit engagement?
Principal engagement partner.
Very good, principal engagement partner. Or sometimes it is also referred as a group engagement partner.
Yes, sir. B.
Yeah. Then a component is in a group. Audit refers to an entity or business activity for which the financial information is prepared and that is included in. Where do you include the group, or where do you include the components, business activity and the financial information?
The group.
Very good. Yes. Yes, very good. So group financial statements. Yes.
Yes, sir.
Which standards on auditing deals with the audit of CFS? Very good. Very good, Sanjay, Geeta.
600.
Very good. 600.
Yeah. Use of.
Component materiality is set by the group engagement team for a component and must be.
Lower the lower than the group materiality.
Yes, very good. Lower than the group materiality. Very good name. Yes, lower than the group materiality. Because it's a component, it has to be lower than the group materiality, cannot go higher than the group materiality. Or not even equal. Reason because if you make equal to the group materiality, you are saying the component in the group is equal, which will not be the same. Adjustment to the financial statement for consolidation are classified into permanent consolidation adjustment and
Current period consolidation adjustment.
very good. Current period consolidation adjustment. Not the prior period, not the extraordinary, not the temporary.
Yes,
Okay.
sir.
So
Yeah, only two items are there in that permanent adjustment. That is a goodwill capital reserve and minority interest on this one,
yes.
equity value.
So
Only two
let's
items.
take, yeah,
No,
let's
sir,
take one more.
minority interest is also considered current period.
No, no. The thing is that the value, the equity value of that amount portion pertaining to that determination of the value of equity value pertaining to minority interest or NCI. That portion is formed part of the permanent consolidation adjustment.
But sir, as
Hmm.
per CFS, NCI at balance sheet date, value
Hmm.
considered at balance sheet date. So every year NCI is changed. So that is also be current, yeah,
No,
only
so
for
see, again, I'll tell you. Now, what happens is once you determine it, it only changes when you have a change in the holding. So if you have a change in the holding and change in the percentage, then it will change. Otherwise, it will not change. Your minority interest will remain the same.
no sir, but in study material, current period consolidation adjustment verification point is also included calculation of minorities or NCI.
Yes, because that's a permanent one, no? That's a permanent one. So once you calculate, if there is any change year on year basis because of any effect, then it will be current one. Otherwise, it will not be current one. So what is current one? Again, now it can be divided into two categories. But again, the question, the important point comes is it changing year on year?
Yes,
Yes,
sir.
sir.
Yeah.
Only the value. See, my understanding is that only the
So share of
value of the equity
Wait,
portion,
wait.
other than the equity portion, will form part of the current period adjustment.
the share of post acquisition.
Yes. So that's why I'm saying. So if it is changing year on year because of the transactions which are happening on the yearly basis, that is the current. If it is done at the time of acquisition and it is going to remain the same, it is not going to change, it is permanent. So if the minority and non-controlling interest is changing because of the profit adjustment or something which is on the year-on-year basis, that will be the current part. It will not be a permanent part. So the current or the permanent classification is done on the basis of the change, whether it is being affected by the transactions which are happening during the year, or it is being something which is decided at the start of the year, or sorry, at the start of the investment, and then it is not changing. So that's where the classification comes. Now, tomorrow you may bifurcate a particular transaction into current adjustment and permanent, both fine. But the concept remains the same, that permanent will remain the same. Once decided, it will not change. Current will change year on year based on the transactions which are undertaken. So don't go by the list. List is indicative. Like what are the transactions you can enter into. But the main concept goes is how to determine the current or the permanent, and why it is important. Understand why the bifurcation between current and permanent is important. The bifurcation between the current and permanent is important because it will help you to audit that transaction accordingly. If I classify a transaction permanent, I audited the last time, that should not change in the current year, that's a permanent. Whatever I audited in the last time, I have to just revisit whether the auditing procedures, whether the things that I performed last year still hold same, and is it the same one? If yes, then are you required to re-audit in detail again? Answer is no. But if it is a current, then yes, you are required to re-audit that particular adjustment. That's why we bifurcate between current and permanent one. Clear?
Yes, sir.
So don't go just by the list. Understand the concept, why the list is given or why the classification is given. Any doubt? Any further doubts?
It's clear, sir. And the question number 5, they are asking, one is the permanent consolidation, what is the another one? Another is current period consolidation adjustment. That's clear.
Yes, yeah. So 5 is the B1. 5B is the correct answer. Okay. If no further doubts, then thank you guys. Thank you for participating in today's session. What I expect from you guys is read the chapter, read in consolidation, read in connection with SA 600. Go to SA 600, read that, and also read this particular chapter and practice the questions from this particular chapter. Okay. And if you have still any doubt, don't hesitate to ask. Ask as much as you can. Ask multiple times. No problem. Okay.
So, sir, I have one question not related to this.
Mm-hmm.
I ask now,
Yeah, definitely. Yes.
sir, with respect to NOCLAR, that we studied about section 260 is applicable for senior accountant in service. 360 is talk about the professional accountant in practice. See, actually, one confusion on that I revised today morning. The thing is that in SA 260, it's talk about the listed entities, only
Mm-hmm.
applicable for the listed entities.
Mm-hmm.
And for 360, when we come to 360, it's talk about listed entity and the 250 crore turnover
Yes.
is also is there.
Yes.
So is the both see, I am very clear about the 260. Now only the I am have doubt on the only 360,
Mm-hmm.
where the professional accountant in practice, the
Mm-hmm.
applicability of this no class, no class is talks about listed entities, and there is a word is given, and turnover is 250 crore and more, where the Ind
Mm-hmm.
AS is applicable. Is this a both condition to be applied or any one, sir? That's what my question
Okay.
doubt.
So for that, let me take you to the code of ethics itself, because see, in case of any doubt, we always go and refer the code of ethics and the wording accordingly, and on the basis of that we.
Sir, so okay, one minute. I went through the code of ethics also. I immediately gone through the code of ethics. What was the in listed entities name only is given, but in the study material it is given as a listed entities, and the 250 crore limit is there. In code of ethics, the 250 limit turnover is not given.
No.
If you
Okay. Let me show you.
if you open the study material, yeah, okay.
Just give me a minute. Let me open it for you.
So if you have time, you can go through. Otherwise, we can see in next class also. It's not a matter.
No. Just a minute. Let me open it for you. Give me a minute. I'm opening it. Because scenario is that in the study material also I have gone through that. It is there. The limit is there. Even I remember when we discussed the notes also, when we prepared the notes for no class, at that point in also time I specified this part. Just give me a minute.
In the module 3,
Yeah. Okay. Let me just give me a minute. Let me show you. So when we discussed, remember, this is the notes from the nuclear itself. At that time also, I said like audit of listed entities but they should be having net worth greater than the 250 for the professional accountant in practice.
Sir, we cannot see.
Yeah. Now, can you see? Yeah, it was taking time.
Yes, sir.
Yeah. So it was net worth greater than 250 and audit of listed entities that we discussed.
Both conditions satisfied,
To be
right?
satisfied. Yes, yes. Both conditions to be satisfied, then only you it will be applicable.
Okay.
Now, so that is the one
For
thing.
as far as that, as far as the 260 is concerned, only listed entity, the limit is not provided.
Yes. Now, where it is there, like this limit from where it is coming, you are right. It is not there. Like you, if you'll go to 360, you will not be able to identify. The limit is not there. For that, what you need to refer is this one. There was an announcement by the Ethical Standard Board, okay, where they they provided some clarification on some of the parts. Now, if I take you through this one, responding to non-compliance with laws and regulations, okay, section 360, over there it is there, applicable to audit engagements of the entities, the shares of which are listed on recognized stock exchange and have a net worth of 250 crores or more. Earlier, it was applicable to audit engagement of all listed entities. First, as of now, it is 250 crores or more. Later on, they will notify for the others. But as of now, this is the one based on the announcement which was there on 22nd September or like 29th September 2022. From there, the 250 limit is coming. So that's why when you go and see the code of ethics, you are still able to see this one applicable to all audit engagements, audit engagement of all listed entities.
Okay, sir. Thank you so much, sir. Sir, the code of which section you opened, sir, just to show the navigation alone.
This is the announcement basically.
Oh, okay, sir.
Not the code of ethics. This is the additional announcement which was done.
Oh, okay. Fine, sir. Sir, thank you so much. I have another question. I will discuss with you later.
Not an issue. Yeah.
Okay, thank you, sir.
Okay then. Okay. Any other doubts? Any other questions? Like with respect to what we have discussed? Like even this one? No? Okay. Then thank you guys. Thank you for participating in today's session. I will see you in the next session. Thank you.
Thank you so much, sir. Good night.
Thank you. Good night. Nisar ji? Nisar ji?